Okay. We'll just quickly wait another 2 minutes or so for everyone to kind of tune in, and then we'll start the session off. Perfect. Well, we'll wait another 2 minutes until everyone kind of joins in, but I'll quickly introduce myself before we start. Some of you may remember me by email. I was helping the Future VC team organize the autumn cohort for the internships. I'm now the program director at Supercharger Ventures, where we are an accelerator and incubator that focuses on educational technology. And we run about 3 cohorts a year and 2 incubator cohorts a year, running for 3 to 6 months. So kind of moved into the VC space myself as well. So just covering for Seb and Julia today. So if you do have any questions, feel free to pop them in the Slack channel, and then Seb and Julia will get back to you as soon as possible. And the recording for this session will be up on Notion, I believe, on Monday. So today's session is on investing in SaaS with Lucy Clark from Octopus Ventures. So I'll hand it over to you, Lucy, to get the show going.
Awesome, thanks so much. And yeah, thanks a lot for having me. Nice to meet you all, kind of a strange location. Let me just share my screen, and I'm sure there'll be at least one technical hitch, so bear with me. Let's see, that's that. Cool, hopefully sharing the right version of my screen. Yeah, cool. Right, yeah, so perfect. Today we're going to be talking about investing in SaaS. I will skate over my disclaimer slide and start with a quick intro to Octopus Ventures, which is where I work. So we are part of the broader Octopus Group, which is, and you may have heard of kind of Octopus Energy, which is also part of the Octopus Group, seen some adverts on bus stops and things like that. But the ventures part of Octopus Group is a 1.8 billion European fund investing across 5 key areas. So those are consumer, fintech, deep tech, health, and most importantly, not just for the sake of this presentation, but because it's the team I sit in, the B2B software team. So we invest from the seed to the Series B stage, and the Series A is kind of our sweet spot where we most kind of like investing. Usually check sizes of £1 million up to 10 million. Since 2008, we've backed over 120 companies, invested about or more than £100 million every year. And some of the companies that Octopus Ventures have backed have gone on to join forces with some of the world's largest businesses like Microsoft, Amazon, and most recently Snapchat and Etsy, which is quite exciting. A bit on my background, and feel free to ask questions, because I guess there's not really a kind of standard background of going into VC, but I guess mine wasn't at all. So I studied classics at university, and then went on to join Goldman Sachs investment banking division kind of 2 weeks after my finals. I did at first equity capital markets, so helping kind of later stage businesses with their IPOs and helping them list on the London Stock Exchange, and then moved into M&A for a couple of years where I sat across consumer, real estate and healthcare, doing a bunch of different financial products. Then I decided that I didn't want to do M&A or ECM. So I left, did a year of traveling and volunteering, and then decided I wanted to go into VC. So started that job hunt just before COVID hit, perfect timing, and then joined Octopus last year. So I've been there just over a year now. Cool. So that's Octopus. This is the agenda I've put together for the day. So I'm going to start very kind of basically with what is SaaS, the advantages, why investors love SaaS, then run into kind of some metrics and the kind of key aspects of the businesses that we care about, what else we care about other than metrics, and then kind of common red flags and pitfalls that I've come across within SaaS businesses over the last year since I've been in ventures. Then Seb mentioned it would be helpful to include something on kind of stage by stage SaaS investing and how investor expectations change from kind of pre-seed, seed, through Series A, and then Series B and beyond. So I've put together a very busy slide on that, so something to look forward to. And then finally, I made a slide on kind of who the top SaaS investors in London are, basically the people that I come across on a day-to-day basis, other investors. So starting with what is SaaS? Sorry if this is super obvious, but I thought it's quite interesting to start with a bit of history and a bit of kind of information about SaaS. So software as a service essentially refers to a cloud-based service that allows users of software to access it through their browser or a web-based app, either via a monthly or annual subscription. So very basic, but always helpful. And then bit of history on where SaaS came from and the kind of domination of the market from over the last kind of 10 to 15 years. Essentially, enterprise software was previously dominated by on-prem solutions, but saw a rapid growth in SaaS market share. I think it's 6% to 75%, and now over 80% of enterprise software is delivered through software as a service, which is amazing. And finally, on valuations, I could talk about this all day, but it's there's a lot of debate around whether SaaS businesses deserve the sky-high valuations in both private and public markets. But rather than me focusing on that, focus on the facts, and that is that the SaaS company valuations are at all-time highs and don't seem to be going anywhere, which reflects investors' insatiable appetites for SaaS. Ultimately, moral of the story there is it's a great time to be a founder of a SaaS business, also a great time to be an investor in SaaS businesses, because it's a lot of stuff to look at. So starting with a bit on kind of the advantages of SaaS versus on-prem and why 80% plus of the market of enterprise software is now SaaS. So the first one on accessibility, you can run your applications through an internet browser or across multiple different operating systems like mobile, computer, etc., which is already a huge advantage versus on-prem. Updates, the ability to launch updates in the cloud. You can kind of update your software centrally without adversely affecting business operations for users. So that avoids the usual pitfalls that on-prem solutions have of having to testing and then slowing down the development cycle. Then the need for hardware. Obviously, some SaaS is connected to hardware, but generally one of SaaS's biggest selling points for investors is the lack of initial investment required to use it, which makes it ultra scalable. Kind of all of those, come together to create incredible market reach, so vendors can supply their software to the majority of the market rather than just a reachable and limited segment of the market. It means that pricing can be cheaper and make it more accessible. Back to the first point. Then saving in storage. So on-prem storage of data means the need to invest in reliable backups, such as cloud and disaster recovery plans and things like that. Can be kind of really expensive, and this kind of mitigates that. Then data and analytics, finally. So SaaS makes it really easy to capture data, provide it for analytics use. So businesses have been using SaaS software. They often have access to kind of reporting and intelligence tools that can help provide valuable insights into business operations, allowing for loads of different types of workflows to be streamlined. So that's the final advantage that I've put down. So now, why do VC investors love SaaS? So as I'm sure you all know, they're not always the sexiest sounding businesses. I think I've looked at a lot of kind of construction tech, a lot of facilities management software. So not necessarily the sexiest businesses, but as you can see on the slide, predictable recurring revenue, it taps into kind of, the recurring revenue, which is the obvious one. it taps into kind of modern consumer preferences. Rather than putting loads of money into a single purchase, consumers can now generally prefer lower, flexible price products that can be accessed instantly, but also cancelled instantly. They're often very capital efficient, as we mentioned on the previous slide. And ultimately, there is a SaaS playbook for how to build and scale SaaS companies kind of across industries. So it's very much the business model that has this playbook that can be kind of executed time and again across different industries, which is really attractive to investors. And as I mentioned before, rolling updates, not just useful because of delivery times, but also it really helps businesses offset the need for their own internal infrastructure, and it can really encourage customer retention as you continue to build products for their customers that are incredibly sticky. So all great stuff on why investors love SaaS. So a quite ugly slide, sorry about that, on what in metrics investors care about. So the recurring nature of SaaS inherently lends itself to kind of measurability, predictability. And as the SaaS market has matured, management teams and investors, both on the private side and on the public side, have become kind of more and more sophisticated on how they use metrics to evaluate SaaS businesses, and kind of more strict about the metrics they want to see in order to invest in these businesses. So it's super important for founders to be tracking these metrics right from the get-go. Metrics provide obviously an in-depth visibility into a business's strengths and weaknesses, and help investors easily identify whether a company has found their product market fit, as we call it. They can be used to identify and clear up issues very early. And obviously strong metrics can be used to leverage outbound marketing, or can be leveraged in outbound marketing efforts. So finally, investors use metrics to evaluate, benchmark, and determine which companies they should fund. Strong metrics lead to more investor interest, higher confidence in investing in the companies, and ultimately higher valuations. And then in terms of thinking about exits, metrics play an important role in proving the story of the business, driving strategic value outcomes. And for companies that decide that they want to go public, they're often used, these metrics are often used to benchmark them against other public companies, often not ones that you would immediately think are directly kind of comparable to that company, but potentially just software as a service, but in a totally different industry. So that can be really interesting. And then an even uglier slide, sorry about that, but with some more information about what kind of looks good to investors. And this actually can be a bit varied from fund to fund, but this is generally what I've seen, and probably correlates with what other funds generally think about in terms of what looks good. So the first one, MRR and ARR growth. Obviously, it's really important to see really strong growth as you're looking to invest. Generally, at the seed stage, I would like to see monthly growth, monthly recurring revenue growth of greater than 10%. That's probably quite punchy, but that would be great. And a yearly ARR growth of over 100%. And then obviously, as you move through to kind of Series A and then Series B, that growth can kind of reduce slightly, and that's still okay as long as it's abides by the rule of 40, bringing nicely onto the second square. So the rule of 40 is sort of a high level benchmark that adds growth rate and EBITDA margin together. So intuitively, the rule follows that it's acceptable to be a loss-making business as long as you're growing really fast, and you've got to make more and more money as your growth slows in terms of profit. So at scale, your growth rate plus your EBITDA margin should be greater than 40%. Next one, LTV, lifetime value to customer acquisition cost. So that one is basically trying to understand, how much it costs to acquire your customers and how much they're actually worth, and whether the worth of the customer, essentially, which is the lifetime value, is 3 times better than the cost the cost of acquiring that customer. So we generally think of three times being good. Actually, going much higher than that starts to suggest that more money should be being pumped into growth rather than, so you should be kind of using your engine to buy more customers rather than that one customer having a really strong lifetime value, if that makes sense. So CAC payback, so also customer acquisition cost, but how long before a new customer pays for the cost of signing them up. So usually we think about that for early stage businesses as, less than 6 months is very good. Less than 12 months is pretty good. And actually that kind of depends as well on how big your contracts are, and things like that. So for enterprise versus direct to consumer SaaS, that could look quite different, but generally I think those rules kind of hold, I'd say. So then next one down is gross margin. So I probably should have gone down and then across, but never mind. So gross margins, 80%, greater than 80% for SaaS business looks good. Low gross profit margin can indicate the kind of heavy services layer, which would typically be less scalable. So often we see SaaS businesses kind of masquerading, or actually, sorry, consulting type, slightly less scalable businesses kind of masquerading as SaaS, who've kind of built in a very heavy consultative layer into the business, which it can easily be identified when you look at the gross margin. So it's a kind of, if you see a gross margin of 40% or something, the first question is, what are you paying for during the process of acquiring the customer, keeping the customer? Is it something to do with customer success that's really taking a lot of spend to actually maintain that customer? And then next one, churn. So logo churn, gross churn, net churn. Logo is obviously your actual customers. You don't want that to be greater, well, you want it to be less than 7% every year. Gross churn, less than 10% per annum. And net, obviously, if it's negative, that means it's good, which means you're kind of upselling your existing customers more than you're losing from the ones who've churned off the platform. And that's actually quite commonly seen in SaaS. So if it's not negative, sometimes it's seen as bad, which not necessarily the case, but again, can be very dependent on size of your contracts, what good sales cycles look like, and things like that. For example, for a business targeting SMEs, you might see a lot more kind of inherent churn in the business, because smaller businesses, go out of business more. If you're targeting startups, they might not all, succeed. So you'd expect natural churn in that. Whereas if your customers are all enterprise businesses, seeing quite high churn would be a really bad sign, basically. So finally, renewals. So clearly you want to see your customers are renewing annual or multi-year contracts. And if you see lower than or higher than 10% or lower than 90% of renewal rate, then there might be something wrong. Why are customers, at that point, we'd be wanting to diligence kind of why customers aren't renewing. And if they're finding other solutions or something's wrong with the solution that they've had, we probably want to do some diligence around that to try and improve the renewal rates, if that was one of our portfolio companies. So I'm kind of charging through this, so it might be less time than I thought. So sorry about that. More time for Q&A, I guess. But the next slide is, what else do we care about other than metrics? Clearly, financials and the metrics are really important, particularly as you get later. So Series A, Series B and beyond, really, really important for metrics, but they're not the only driver of value. So these are the key ones that I look out for as well. So the first one is on a diverse and experienced team with founder market fit. So I think founder market fit is such a great expression. It really kind of captures when the founder is just kind of in an industry that they are absolutely made for. And I've come across quite a few of these recently. It's just so exciting, and they're really building something they really understand. They've had loads of experience doing, and that's just awesome. And often you want to see a team that's like either not kind of all technical founders or not all commercial founders, and kind of a bit of a mix. And clearly that's more likely as you get later stage. Sometimes we meet seed businesses who only have technical founders or vice versa. And part of the raise is to build out the other side that they don't yet have. The next one is on, obviously, we'd like to see innovative and differentiated tech that is highly defensible in the future. So not kind of something that someone could kind of copycat overnight. And these, we want them to be kind of highly scalable and placed in high demand. So they're kind of raising the company's profile. Next one is actually really, really important, especially for ventures. So massive growing end market with strong tailwinds. So your accessible market is just so important. Accessible and addressable market. So you've probably heard of TAM, SAM, and SOM. So TAM is your total addressable market, and that refers to everyone worldwide who could buy your product. SAM is serviceable addressable market, and that's the market that you can acquire with your product. So geography, vertical, etc. And then SOM, which is serviceable obtainable market, is your portion of your market that you can use to get that you can get to use your product. So whether you're targeting enterprise or SME, kind of the more realistic estimate of what your addressable market is at the point in time that you're looking at the business. We see all kinds of crazy numbers for these. And I think really important that investors, anyone looking at business, does their own analysis on what they think the TAM looks like, because I mean, you can easily look at, for example, construction tech and be like, what's the spend every year on construction? and come out with like a TAM that isn't at all relevant to actually what the software is that the company is producing. So it's just really important to be really thoughtful about how you're sizing your market. And the reason we're interested in huge markets is that ultimately, if you want to build a unicorn or a £1 billion business, you need a market that's big enough to have one or more of those, especially if it's not a winner takes all market. Sorry if you can hear the drilling in the background. Next on the list is blue chip customers, and those who keep coming back, as we spoke about the kind of renewal rates is important. So having a large and growing base of well-known and repeat customers provides strong product and market validation for the SaaS businesses, and also low customer concentration reduces risk as well. So often we see, particularly at the seed stage, maybe 1 or 2 key customers, and that sometimes is obviously has loads of concentration risk. If one of them churns, then what happens to the revenues? Or they have like 10 customers, but 75% of their revenue comes from one. That's also clearly a big concentration risk. So kind of not too concentrated, but blue chip names, often, there's a bit of obviously it's great to have names that people have heard of and logos you see on the page that are businesses that kind of we know will have done their diligence before taking on the product, can often add a lot of credibility to those businesses as well. Next, a clearly outlined but not necessarily defined go-to-market strategy. So a clearly thought out strategy for finding and signing new customers with visibility into their pipeline. And particularly with the visibility point on pipeline is really important for companies with kind of much longer sales cycles. So when we invest in SaaS businesses, the capital is actually, it should be the fuel for the sales and marketing engine. But you're not going to put fuel into the engine if it's not working. So it's really important to understand what their sort of outbound sales strategy is. If as part of the investment they're building out a new strategy, why they think that's going to be successful. And I think that's just a really important consideration generally. So by being clear about what your sales and marketing model is, and knowing your metrics, and why so kind of thinking about how much, and another piece of that metric kind of stuff we look at within the go-to-market strategy is sales efficiency. How strong are your sales team? How long does it take them to ramp? And like, why if you add 10 salespeople, they'll be able to create X amount of revenue in a certain amount of time. Like really understanding that machine and how kind of well-oiled it is really, really important. So that's that. Finally, the kind of broader competitive landscape dynamics. So the number of other players in a sector can really limit or influence both current and future growth prospects for a business. Obviously, the one that came to mind when I was putting this together was the kind of restaurant QR code businesses. So a lot, you all will have seen as you've been to like restaurants and pubs post-COVID, during COVID, whenever it's been. There's every time basically you have to download a different QR code app or something. So we've looked at a bunch of these businesses who've created a SaaS product for restaurants to manage the orders and customers, etc. But there are just so many of them. We found it really difficult to have conviction that one would win, or that there would need to be one winner, but ultimately that anyone could become big enough to kind of sustain a £1 billion business. Cool. I think that's that on that slide. Next one, common red flags and pitfalls within SaaS. So we've sort of touched on a bunch of these as I've gone through, but I can give a bit more context here. So the first one, hyper specialization. Often we come across SaaS businesses that have been created as a solution for a particular company. Sorry to bring up construction tech again, but I did see one the other day that was essentially had built a tech solution for a particular construction business. And essentially my view on the company was that was a great solution for that company, but ultimately it was hugely consultative and not necessarily transferable to other construction businesses. So in that case, I'd want to explore whether the problem really is exactly the same across the industry and how transferable it is. But yeah, companies that build too much for a particular problem for one particular company often find it really difficult to scale with that solution, and find that although it's a deep product, it's not something that people need and they're not willing to pay for as well. So the next one is creating a feature versus a $1 billion business, $1 billion business. So that's another thing we see quite a bit, is some quite cool kind of add-ins and things like that, but things that are nice to have, but not necessarily the makings of a huge business in the future. So that can be quite a tricky one to spot, but also it can become clear when you talk to customers and understand, like, well, it's kind of interesting, but not that exciting, and there's not a huge product roadmap to build it out even more. Next one, a solution that's only 10% better than what kind of exists already. That's something really quite common, actually, that someone's built something to address part of a problem, and actually it's only a tiny bit better than what's there, which means it'll be a really hard sell, because often with software, and particularly with enterprise, they don't want to rip out what they have for something that's only a little bit better. And so trying to demonstrate that your return on investment for buying that product is really, really strong is really important. So often when we analyze businesses, it's thinking like, is it just 10% better, or is it actually upheaving the way that this whole thing's being done, making it a really easy sell for the customers who want to buy it. So the next one is having a huge customer education or behavioral change piece. So I guess that sounds slightly contradictory to the previous one. Often that's needed to create a new category, and that's a challenge that they'd have to face. But sometimes products are created that are seemingly identified by people who don't really understand the needs of their customers and are trying to create something for a problem that doesn't really exist, or they're trying to make a huge change in the way that customers do things. Again, construction, really good example. It's really, really hard to sell into these businesses who do not want to change the way that they do things. So having that really big gap, trying to find a way to bridge it in some way, whatever it is, whether that's kind of being able to plug into various existing CRMs and things like that, or just having a really easy sales process, a really kind of executable one. That's also important. Next one is a classic pitfall, kind of works across businesses, not really just SaaS, but trying to go overseas too quickly, spreading your resources too thinly. I think often SaaS businesses, or all businesses actually, they see some success in a geography and they're like, oh, the US sounds really attractive, I'm just going to go there. But not having any boots on the ground, not really understanding the local market, and taking resource out from your existing market where you're actually doing pretty well can be a massive pitfall. And often we have to sort of slow companies down from wanting to go to the US, because it kind of makes sense to try and succeed in your home market first. There are exceptions to that rule, but ultimately, I think trying to have success in your home market first, and then building out a team through kind of a future funding round makes a bit more sense. And finally, not having a defined ICP, so an ideal customer profile. This is really important because as companies look to scale and sell into customers, they're going to have a hugely inefficient sales engine if they don't really understand who their ideal customer is. So we really like the ones who have kind of nailed down their ideal customer, and they know exactly who they're targeting within the business, and they basically have a really high success rate when they go out go out to sell. So often that's, oh, we think our solution is actually applicable across industry. Great, but who's going to use it? How do you sell it? What are the examples? Are they going to be relevant for that company? So really not nailing down your ICP can actually be a massive pitfall from what I've seen. wow, really busy slide. I'm just gonna run through it all because I think it could be interesting. And essentially I've tried, the green bits indicate what I think are the kind of most important focus areas at that stage of the business. So as you can see, for the pre-seed and seed stage, I think the most important focus area for the investor for SaaS businesses is on the team and the vision, but mainly team, to be honest. And that's because the company itself might change quite a lot as they continue to discover and develop their product through the Series A and B. So you're essentially backing the team who's going to execute on that. So things like having had a previous SaaS business or a lot of experience building a SaaS team, really getting your industry, etc. These are really important considerations for pre-seed and seed. Series A, I think it becomes much more, obviously team is still absolutely vital, but it becomes about starting to nail down your go-to-market strategy, your ideal customer profile, and you've kind of got your product launched and you're having some success. So usually we think about kind of 1 million of ARR-ish for Series A, probably more, or maybe a bit less at the moment in a kind of hot market. And then finally Series B and beyond, I think metrics are kind of most important, but obviously not to the detriment of the other segments in the table. But I think that's what Series B investors are most focused on. So when we look at Series B, we do have like set metrics we want them to be at. And essentially where they're kind of ready to have oil put into the machine in terms of their sales process. Okay, so just to run through in a bit more detail some of the other points. Pre-seed, in terms of metrics, usually pre-revenue and can be. So like that's fine. Investors aren't necessarily expecting at the pre-seed stage that you'll have revenue. In terms of team, we've been through that. Might change, the company might change, so the team is really important. Then on product for pre-seed, probably expecting maybe a bit of wireframes, vision, what you might use it for, and have done a fair bit of market research on your problem and why it's going to be a huge company. Then in the use of funds, it'll be used to hit a preliminary target, and then you'll raise your seed usually. So then on the seed stage, we usually like to see kind of the beginnings of revenue in the SaaS world, because of this whole point of it being very predictable, etc. Knowing that someone actually wants to buy it is really important, even at the seed stage. So just having kind of some pilots that aren't paid isn't really enough usually for us, but that can be different for different investors. And obviously can be overruled by things like a really strong team, really cool product in a market that you have a really strong thesis in. So there are always exceptions, but generally I would say what I've seen is having a bit of revenue is great at the seed stage. But there's no like, you have to have hit 50K or something. In terms of product, you probably want an MVP, an early version of the product in your customer's hands, and being able to develop that further. So beta customers, things like that. Finally, on use of funds, you're wanting to give your company cash to allow it to meet kind of product development goals, expand the team, and start actually making revenue. So that's the use of funds for a seed business generally. Then Series A, around 1 million of ARR is great. We've invested in ones with less and ones with more. It can be quite varied, but that's usually the benchmark investors talk about. Really strong growth. I think I referenced 100% for seed earlier in the deck. So just so I'm not contradicting myself, 75% plus for Series A is probably good. Then evidence of improving unit economics. So I wouldn't necessarily expect a company to be like at 3x LTV to CAC, but maybe getting there or having shown improvement as they've kind of developed economies of scale and a more efficient marketing machine, things like that. And then team, obviously a diverse and strong team, and starting to identify key gaps that they're going to need to fill before they start scaling. Then on product, starting to nail down their go-to-market strategy and ICP, and having launched their main product, most likely with some success. And then the cash for the Series A is needed to expand on revenue, optimize existing processes, and ultimately prepare the company for scaling. And then in terms of Series B, We do invest at that stage as well. And as I said, much more focused on metrics. So usually around 5 million of ARR. Again, we've gone much lower than that, 3 million, depending on the business and what the pipeline looks like usually, and how sort of certain we are around that pipeline. Then we want to see consistent growth and margins. So margins rather than growth over 80%. I think we've actually looked at stuff even over 60% growth or 50 at the Series B. So not as, obviously you want to see strong growth, but margins are really, really important as well. And then these unit economics, you want to see them like having really kind of been proved out by this point. So 3 times LTV to CAC payback, and limited CAC payback probably less than 6 months, 12 months, depending on the enterprise versus SME target. And then limited churn in the business, or if it's, you know, SME targeting, as I mentioned earlier, you'd see natural but kind of offset by that net churn number being negative. Then a diverse team with a strong board, I think you'd want in place by the Series B. You probably wouldn't mind as much if you didn't have like the original founder, for example. You just want to have the right person who's going to scale the team and take the company through that next stage of growth. Then yeah, so you have an experienced C-suite team for the scale up stage. So not always people at Series A, seed and pre-seed don't always like the challenge of the Series B, C and public market kind of stage of a business. So often I meet founders who've started a business, grown it to success, or some success, like Series B or more, and then decided to leave and start something else because that's the part that they really enjoy. So that's really interesting. And then on product, clear product market fit, and then time. Obviously, it'll be then time to scale, potentially to scale into new geographies, although not always. Have their ICP agreed, go-to-market strategy being executed on, and essentially just needs fuel for the fire. So the use of funds for that is, you know, you have strong KPIs and monetization strategy, just need cash that will help you scale and reach new market segments. Okay, so that's that. Hopefully useful summary. Finally, who are the great SaaS investors in London? Now, this is a non-exhaustive list. I just put down some names of other funds that I think are great and that I work with a lot and speak to kind of on a weekly basis about either their portfolio companies with regard to those at the pre-seed and seed stage. So a lot of my kind of origination strategy is looking at the really great funds at the earlier stages than we invest, and then targeting their portfolio as potentials for investments. Not the only way to find businesses, but these are ones that have had really cool SaaS portfolio that I know of. And then obviously see us in the middle, try to have us kind of bridging seed and Series A, because that's what we do both. And then put in some growth names, those who kind of follow on into our portfolio, and particularly our SaaS portfolio as well. Cool. So I think that is the end. That's my email address in case anyone has any questions at the end. But yeah, I'll stop sharing there.
Perfect. Thank you so much, Lucy. Even I learned quite a lot was listening. Usually I turn out.
That's a great sign.
Yeah, thank you so much. We do have a couple of questions in the Q&A section, so I'll just quickly go through them with you. So the first one from one of the attendees: how much is investment banking a necessity for building a path into VC? And what should you do if you don't work in that area?
Great question. So absolutely not. I don't think it is. And it's actually one, I have this conversation a lot with people who reach out asking for sort of tips on how to get into VC. I think it's one thing that actually really attracted me to the Octopus team, which was how diverse the backgrounds were of the people at Octopus in the team. So there are a few of us who have like a bit of investment banking experience, like 2 years and 3 and then 4 years in my case, or almost 4 years. And then there are people in the team who come straight from doing PhDs in bio, that come from literally the lab, thinking about kind of various products and their commercialization, literally to the investment team. So that's really cool. And then another guy on our team, he worked in an abattoir, then had his own pig farm, and then a whiskey business, and then went into VC, and now he's in our health team. So it's really amazing. And like another person in the team was a lawyer. Now she's in our deep tech team. So I think, it's one of those industries that actually you can go into it from anywhere. And there are paths that make it a little bit more of an obvious route. But I wouldn't be kind of demoralized by like not having investment banking, not having operating experience, because that was something that I felt kind of inadequate, not having had that kind of operating experience. And I would love to have had that. Hopefully in the future, I'll be able to do a bit more of that. And so I think, you don't have investment banking experience, it doesn't matter. Think about the other things that are needed in VC, the other skills that you need, and being an operator, really understanding market dynamics. There's just so many skills that you need. Like you're going to find a place that really suits your skill set, I think.
Thank you, Lucy. Look at me. I started off in hospitality and founded my own startup. And now I'm in an edtech VC. So there's always ways, and I think there's transferable skills, whichever industry that you're in. So you're definitely right about that.
Yeah, I would just say actually as a quick add-on is like, I think the later stage you go in terms of investing, the more technical skills are required because of the more metrics and numbers that you come across. So when I look at a Series B business, I find myself using a bit more of the like banking skills that anyone can learn, by the way, like overnight. If you put time in, like you'll be fine. But I find myself using those a lot more for the much later stage ones versus like seed business, no numbers. They have like revenue charts that go like this that, no one knows what's going to happen. So there's no way of kind of you even building a full model or anything like that. So it's much more about kind of intuition about the team, about the market, and that kind of thing. Yeah.
Perfect. The second question from Simon says, as SaaS subscriptions can be cancelled at any time, isn't that a big risk if for some reason mass exodus of customers, mass exits of customers occurs?
Yeah. Okay. Great question again. Sorry. Yeah, I mean, that's a great question, I think. And yes, it is a risk and it's something that happens. Not all businesses, not all SaaS subscriptions can be cancelled at any time. Often you're in like a 1 year, 3 year contract. I would say like in the case of a SaaS business like Netflix, which is a D2C SaaS business, which I haven't really focused on because I do much more B2B. That is a big risk. And that's something that the investors, if you read their like S1, is something that they track closely, like how many people are cancelling randomly in the middle of a subscription period. And it's one of the metrics that you would just want to track really closely, I think. And yeah, as I said, like that's what I would look at. If I was investing in a business where you could cancel at any time, that would be the first set of data that I'd want. And if the numbers are really high, then that's obviously there's something going wrong there, and you'd want to do a bit of diligence into like what's happening, why the customers don't want to continue subscribing. But yeah, generally the ones I look at, they are actually in kind of 1 year or 3 year contracts. So it's more about the renewal rate rather than the actual kind of cancelling rate. If that makes sense.
Perfect. Thank you, Lucy. The next question is, what is the rule of 40?
Oh, the rule of 40. Okay, I can go back to my deck if that's easier. Hopefully I answered it a little bit, but I'll just run through in a bit more detail in case. So, and actually just to maybe put your mind at ease slightly, I don't often use this when I'm looking at really early stage businesses. It's sort of metric that I would think about much more if I was looking at growth or Series B potentially. So essentially, it's a benchmark that adds your growth rate. So say that's I'm actually not going to do the maths live because I've really stumbled over that before. But for an investment banker, my mental math is pretty shocking. So yeah, high level benchmark, you add your growth rate and your EBITDA margin. So both of those in percentages. And assuming your EBITDA margin at the beginning is going to be negative, you're essentially minusing that margin from your growth rate, which means if it's greater than 40%, that's still great. So ultimately, it's a high level benchmark to make sure you're kind of growing fast enough and making enough profit as you scale to build a kind of sustainable business.
Perfect. Thank you. Are some metrics given more weight depending on the stage of the business, i.e. seed and Series A companies. I think this was submitted before your slide.
Oh yeah. Let me just, so oh sorry, I just raised my hand for some reason. Okay, I think yeah, and as I discussed on the slide, I think I'd say at the seed stage you're looking more just at revenue. How do I lower my hand? Oh, there we go. How do I at the seed stage you're looking kind of more at the high level metrics, and then as you kind of go up the scale through Series A, Series B, etc., you start to look more at kind of sales efficiency metrics, margins, LTV to CAC. So I guess you just place more weight on more metrics rather than kind of discounting the ones that you looked at seed, I'd probably say.
Perfect. And on the topic of hyper specialization, what are your thoughts on hyper specialized SaaS companies that reside in a sector or industry that functions as a monopoly? For example, rail.
For example, what was that?
Rail, right? Oh my gosh, rail services.
Oh, okay.
Yeah.
Yeah, no, it's a great question. So I think I would say that, you know, there's no reason to think that a hyper specialized business or SaaS company that can't be successful, and like absolutely wouldn't necessarily, I wouldn't be like, this is a crap business if it was hyper specialized, because it could be a perfect solution for a company, a selection of companies. I think my key concern there would be that it's not suitable for enough companies to build it into £1 billion business. And that becomes a kind of topic of concern for VCs, because ultimately you're trying to return the fund. And so if the business ends up growing to like 20 million of revenue, which is great, obviously nothing to sneer at, and then becomes profitable, and then that's about it, and it kind of just plugs along with the same customers, doesn't really grow that much more, and it, you know, but it's profitable, so it doesn't really matter. That's not really, it would be a fine exit for a VC to then be sold to a PE company or something, but it's not going to be your like 10x, your 20x return. So I guess with that, you'd be looking, you're thinking like, where can I find the businesses that are going to essentially get me the best return? And that's where you think about your target market, and why, if it's hyper specialized and if it's kind of falls into a niche, it might not be big enough. But, you know, as you say, like rail as an example of a specialized but also massive industry could essentially be fine, because if it's specialized for that industry, that's still a huge market. But yeah, as it depends on kind of what you're able to price it at, and if it can kind of be applicable across kind of all rail. I think what I was thinking was more like, I've seen a company, for example, that's built a solution specifically for HSBC Bank, and that's great. HSBC loved it, and they were like, "Look at us, we've built a solution for HSBC," kind of thing. I actually don't think it was HSBC, but it was a big bank, and that was great. But we didn't really believe that this was a big enough problem for other banks, smaller banks, bigger banks, that it would be something that people would pay for. So I think that's the problem with specialization is one thing, and specializing on an industry, but on a particular company and building out products that like a particular person or team are asking for makes it much less scalable, I think, in the longer term, and more sort of consultative in nature.
Perfect. 3 more questions to go. The first one is regarding companies regarding companies need to be located in the region. If you come across a company that has a competitor that is super hot in another region, like the US, is it a rather good sign or a red flag? How do you think about it?
Yeah, no, it's an interesting one. I think that definitely happens a lot. Like, we look at businesses and we write our IC paper, we look at the competitive landscape, and it's like, who are the competitors? And we're like, oh no, there's actually like a really great competitor that Sequoia is funded in the US. And then we're like, we think carefully about whether it makes sense for our business to be in the US, if it can be a big enough business on its own in Europe or in the UK. And if the answer is, oh, this can only be £1 billion business if it scales to the US, then we probably wouldn't want to invest. If the answer is, you know, if they've already got a competitor that's like completely taken over the market and has superior or the same tech that they have, which is probably quite rare. And the other thing is if it's like a winner takes all market versus a market where there can be multiple players that can build a big enough business to be a £1 billion business. So, there are some markets that require network effects, and in order to be successful at all, need a kind of winner takes all result. And so that can be really tough if you've already got a competitor that's got loads of funding and already is really well known within a certain market. So I think, it's not necessarily, I wouldn't necessarily be like, oh, I can't invest because there's a competitor, but especially if they're not in the home market, that I would think carefully about how big the business would need to be and whether it would make sense to try and move out there and compete actively. Because ultimately what that means is your costs of acquisition will go up in that new market, because you're just going to be competing head on with someone who's very similar to yourselves.
Perfect. The next question from Oscar is, hi, Lucy. Thank you so much for your time. Are there any classical archaic industries that come into mind when you think about potential hotbeds for SaaS going forwards? Your construction examples got me thinking.
Yeah, no, it's a great one. I think it's really, that's something that I get really excited about, actually, because it is these industries like construction and these like really archaic industries that need kind of disruption and need tech in order to actually advance. And so the ones that are sort of top of mind for me right now, construction, as you probably guessed, because I've talked about it like 10 times, and it's just so backwards. But it's a really tough one to get into in terms of building software for because they don't want to change their ways very actively. So it's trying to find solutions that are so much better than what they're currently using, and that they actually want to pay for them. I think another one that I'm actually looking at the moment, which is really fun, is farming software. So farming is obviously an industry that's fairly traditional, and like they have their methods. They do use nowadays they use a lot of hardware tech to like measure soil and stuff like that, really cool, like IoT sensors and stuff like that. But they don't use a lot of software to track their businesses. They're really being squeezed in terms of margins to make money. So it's becoming less and less attractive to be a farmer, but everyone needs food. So like clearly there's a problem there that needs to be addressed. People need to create ways for farmers to track their businesses more closely and make them more profitable, but making those in a way that's like attractive to farmers who don't want to sit at their desks and read and go through spreadsheets all day, or like go through an app online, is a really tough challenge. So that's also a really interesting one. I'm trying to think if there's any others that come to mind. Those are the two that I've been looking at recently, but yeah, I'm sure there are others, and it's really it's really fun to kind of look at industries like that and think like, what would it take for them to adopt a solution, and is the timing right for it? So people, when I told them I was doing this farming software deep dive, they were like, why? What interesting has come out farming? And I was like, well, maybe nothing yet, but that's the point. It's like, is the timing perfect for a solution like that? With climate change, with making kind of weather patterns more and more unpredictable, is the time now that they need a solution that's tracking weather and helping them forecast what they're, I don't know, planting, or I don't know the lingo very well, but these kind of things that might become really important in the next 5 years. And does that mean that now is the perfect time to invest? So yeah, these kind of trends and things to observe are really interesting.
Yeah, I definitely agree that, farming and agriculture is such a...
Yeah, and shipping. Yeah, sorry. Oscar just typed shipping into the chat, which is such a good point. We've looked actually a lot of freight forwarding and helping, so freight forwarding and logistics planning and trucking and stuff like that, like helping these companies become more environmentally conscious, advise their customers on how they can reduce their carbon footprints, things like that. So many solutions that are really exciting in that space as well. So yeah, nice one.
Perfect. And the last question is more a logistics question. Tej is asking, will you be able to share the presentation after the...
Yeah, sure. I can. I just got approval from my marketing team that I can share it.
Perfect.
It's useful.
I think
feel free to reach out to me on LinkedIn or email me if you have any questions or just want to chat. Always happy to, chat.
Perfect. I think if you could kindly send that to Julia, we'll be able to put that on the Notion, I believe.
Sure.
Thank you. Well, thank you so much, Lucy. I think, I don't know if I speak for everyone, but I've definitely learned a lot during the session, and I'm sure all of the future VC cohort has as well. So
cool. Thank you so much. All right.
Have a good day.
You too. Bye.
Bye.